What we normally see is a negative return in the second and third quarters because of the uncertainty leading up to the midterm elections. Traditionally, the party in power loses 22 seats in the House, 4 seats in the Senate. That's probably not going to happen this time around, or at least according to the pollsters. In the Senate, the Republicans could pick up a seat, but they're vulnerable in the House. So I think we're seeing a lot of the sell-off be attributed to the elections, but obviously to be attributed to the earnings and whether we're seeing a peak. Because going back to the 1940s, we have had earnings peaks, not necessarily declines, but peaks in earnings on a year-over-year basis accompany declines of 10% or more. So usually people, I mean, investors are like hyperactive first graders playing musical chairs. They're always trying to out-anticipate the other as to when to sit down. So
but
I think
how do you really figure out when the music ends? Like,
well, that's the problem, because right now we're in a technically driven market. Technicians, we all know that prices lead fundamentals, and I think the fundamentalists are scratching their heads saying, do I fade the fundamentals and adopt the technicals, or are the technicals misreading the information and therefore I should stick to my guns? So I think that's the real question right now. We're seeing valuations come down into a much more attractive area, so we would have to see earnings estimates come down dramatically, I think, to make fundamentals feel that they got well too ahead of their skis.
Now, this is the second relatively sharp pullback this calendar year. I know you've kind of looked at that pattern and what it means.
Only 26 times since World War II. That must be
which is interesting because, you know, it seems as if everyone coming into this year said, well, it's going to be more volatile, and this is kind of what it looks like.
Oh, absolutely. Well, let's just start with right now, October. We are 40% more volatile this October on an average intraday basis than we saw in the first 9 months of this year. October's not a surprise because it's normally the most volatile month by about 15% relative to the second volatile month, which is January. But then, as Joe was saying, the research shows that we've had 26 years since World War II in which, like a whale, came up after being down 5% and then went back down for at least a second time. And unfortunately, about 70% of the observations were deeper the second time than the first time. So there's a possibility that instead of us turning around right here, that before all is said and done, maybe we end up with a 12% decline down to the 2,600 area on the S&P 500, which I think would reset valuations quite nicely and also just reset the emotional dials.